Well, I think right now it is very, very difficult, as you mentioned. The interest rates are at literally historical lows. We are seeing new lows that are being made in the overall marketplace, and certainly it's unprecedented, even in the time that I've been in the business. I mean, we've never really seen anything like this, and it doesn't seem to be changing anytime soon. So, and at the same time that we have historically low interest rates, we have, at least in the United States, we have this large baby boomer bubble of all these babies that were born after World War II, that now beyond the leading edge is in retirement already. The big part of the bubble it has a very short runway to go into retirement. So guess what they all need? They need income. So here they've been working their whole life, they've been saving, they've built up 401k plans, they've built up their portfolios, they've worked with companies like us, and now they're getting ready to retire, and you've got a 1.6% 10-year treasury bond. And so what am I going to do? All right, well, there's a number of different options, but if we look at the more traditional options on income, which is frankly is where people need to look at. Every time in the last decade that people have ventured outside of traditional bonds, whether it be them going into structured investments, whether they're going into hedge funds, whether they're buying windmills and oil wells and all solar panels and all the crazy stuff they come up with, everyone has been a disaster. I mean, disaster, where not only are they not seeing the income, in many, many cases they lost all their money. All right, so there's a lesson in that. Don't be careful of pushing the edge or hanging your toes over the edge, because sometimes the footing below you is not stable and you end up falling off a cliff. All right, and it's happened. I mean, there's just one example after another. So the reality is, what's really worked has been traditional fixed income. And for people that are in higher tax brackets, then overwhelmingly it's been municipal tax exempt bonds. All right, because those bonds are not taxed. None of the bonds are taxed federally. And if you buy bonds in the state you live in, then they also don't have any state tax. So if you live in New York or you live in California or wherever you live, you buy bonds issued by state and local governments in your state, then you don't pay the state tax and you don't pay any federal tax. So they're totally tax-free. So bear in mind, if you have a municipal bond that's paying 1.5% and you're in a high tax bracket, you would have to make 3% to be a taxable equivalent. Because if you paid 3% taxable, then you paid 50% in taxes, which is what you're going to pay in California, New York, some of the high-tax states. You had 3% taxable, pay 50% in tax, you would net 1.5. And so the muni bonds generally are going to be yielding close to that after-tax range. So don't get afraid of saying, oh, I'm only getting 1.5%, because it's really like you're getting 3 and you were getting taxed on the 3. It's taxable equivalent, so it's the same thing. So muni bonds are, they're still going to be in that 2.5 to 3% taxable equivalent type of a range. So it's still not a bad investment. And the key with that is it needs to be managed actively. All right, and we do both. I mean, we do what we call passive ladder strategies, where you buy bonds that are 1 to 5 years, 1 to 10 years, 1 to 15. We actually do all three. And for example, in a 1 to 10, you put 10% of your money in 1 year, 10% in 2, 10% in 3, 10% in 4, and then it rolls down, matures, and you put it back out. The 1 matures, it goes to 10, and you got this ladder, which is why they call it rungs on the ladder, that you're managing. Well, that's fine, and it's very, very passive, and we do it. But frankly, where it's actively managed is really where you're going to get your benefit, because as you look out in maturity, the additional income that you get per year of maturity, because you normally get more interest as you go longer, that doesn't step up linearly. You might find to where you go from 1 to 3 years and it goes like that. And then you go 3 to 5 and it's like that. You don't get any benefit. Then 7 to 10, it goes like that. So it's much better and to be able to manage it actively and rotate it and then gain additional return. Also, you can be a little more selective on the individual issues, because you're not just waiting for it to roll down. You can sell something, buy something. You can be active and add performance. Now, the same is also true on the taxable side, because on the taxable side, generally you're going to have U.S. government issued treasury bonds, U.S. government agency issued bonds, and then you're going to have corporate bonds for public corporations, just like you have stock for public corporations. Now, in all of those areas, quality becomes key. Now, the U.S. Treasuries are going to be U.S. Treasury, U.S. government full faith and credit. It's basically AAA plus. Same thing with the agencies. And the reason you go between one or the other is what pays you more or less, and it's really more of a quantitative decision. On the corporate side, now you're looking at corporations the same way that you look at stocks. And you're looking for their health, you're looking for their earnings growth, you're looking for their cash flow coverage. The only difference as you go down into the corporate side is the corporate market right now is not a AAA market. Okay, the big companies, because they've been taking advantage of lower interest rates, very smartly said, hey, if I can borrow money cheap and you're giving me money for nothing, I'm going to borrow as much as I can. All right, smart. If they say, hey, you can refinance your mortgage at 0 interest, you're going to do it. All right, and that's really what we've seen. These companies say, fine, I'll borrow as much as I can, but that's still debt that shows up on the balance sheet, even though the debt service they're paying at lower rates is very low. So they're still extremely healthy, but they have more percentage debt because they're smart and they're borrowing the money cheap. All right, but because of that, their ratings now ratings in the past were AAA, AA, single A. 85% of the market now is single A and triple B. So if you're going to play in that arena, then that's the schoolyard you play in. And you just have to be aware of that. It doesn't scare us. It shouldn't scare you. These are big, healthy companies, and it's just they're doing smart things, and they're just borrowing more money because money's cheap. So, but that having been said, you need to have professional capability and research analysts and credit analysts on staff like we do to really separate the wheat from the chaff and get in there. But the corporate side does generate higher yields. So now you're going to be able to do 3, 3.25, 3.5, and it's particularly attractive for 2 reasons. Is that if you're in a lower tax bracket, say you're only a 25% tax bracket, well, instead of having the 1.5% net after immunities, you're better off to have 4% in corporates, only pay 25% tax, then you're at 3 net after. So it's very much of a tax decision. And then on top of that, the corporate arena opens a little more opportunity, all right, because there tends to be more mispricings. Okay, you don't see that many articles that come up about the city of LA or the city of XYZ, and going to be that's going to depress the bond. But in the corporate world, that happens all the time. Is that you've got Johnson & Johnson, and all of a sudden somebody says they got a problem with the baby powder. All right, well, the stock sells off, the bond sells off. We look at it and say, there's no problem with the baby powder. And so we buy in, and then all of a sudden it comes back, oh, guess what? There's no problem with the baby powder. The stocks go up, the bonds go up, you make money. That's the deal. That's what you pay us for. And so a lot of that decision is really looking at your taxes and where you want to be, and then you customize the portfolio, to be able to generate the income. But right now, just as importantly, more importantly than ever, because the interest rates are low, is that you've got to have active management to generate return on top of the income. That is, if I can leave you with anything, that is the number one thing right now. It's just not a time. You cannot be passive and lock it up in a safe deposit box and say, everything's going to be okay. You need to be active. You need to be out there. You need to have boots on the ground and making stuff happen.